Hello and welcome to our next session of Bare Bone Basics, where we take what is seen as complex regarding stocks and we simplify that process. So this week we're going to shift from talking about dividend stocks, which I believe are a safer method for those just getting started. And we're going to shift into what we call growth stocks and kind of get an understanding of what's meant by growth stocks, because there are multiple terms that are used and we want to identify or differentiate the two. So let's go ahead and get started. As usual for this year, the focus is on the 8 streams of income. On the list, you see number 5 is dividend income, and we've spent some time there. We're going to shift down to number 7, where we're talking about capital gains, assets increasing in value, and a stock is an asset. So if I can purchase something at one price, hold it for a period of time, and let it grow and sell it later, then I can make a profit, or what's called a capital gain, off of that. I can't buy a car in most instances, hold it and drive it for 5 years, and the value of it be higher than when I purchased it. If you bought it brand new, the day you drive off the parking lot, it's lost value. With stocks, it's different. You could very well lose money. I don't want to make it seem like, oh, if I buy anything, it's just going to grow. That is the farthest thing from the truth. What you're doing is identifying something that you know based off of facts, not emotions, has the capability to improve as a company, not as a product, as a company. And the reason why I'm stressing as a company is because there's various components that make up a company. It's not just the product. It's also the leadership. I always look at who is running a company. If the leadership is horrible, their business is not going to be fantabulous in 9 cases out of 10. So that's just as important. So we're going to look at ways to produce number 7, capital gains. So that'll give us 2 more. Hopefully you already have number 1. You have number 5. We've been talking about that for a while. Number 7, capital gains. Let's get into it. All right. So for our agenda, we're going to differentiate the difference between a growth stock and a value stock. A lot of times they're thrown into the same category, but you have to understand the difference, because that will shift and change your expectation of what you're buying. We're going to look at the difference between dividend stocks, where we've spent time, and growth stocks, because how you actually make your profit changes. And if you understand the difference, it makes it easier to make a better decision when purchasing a stock when you can get both, which is what I prefer to have if I can have it. We're going to talk about we're going to talk about portfolio strategy. Always, you have to know what is your strategy. I cannot stress enough knowing what your strategy is. It's like a vision. Only you know what your vision is. And if everyone has their own strategy or their own vision, it might not be the same as mine. So when a person brings information to me and their strategy is different from mine, without being rude, of course, I'll listen to what they have to say. But if it's not within the same strategy as mine, it may not fit according to the strategy that I'm trying to apply. So for those who seek knowledge from several places, and I'm one of those type of people, I'm always researching something. But I keep in mind the person who's given their opinion, because that's what it is, their opinion about a specific stock or where a company is going. I take in what they're saying, but I also have to apply it within my strategy. So you have to know what your strategy is. What is your method? What are you trying to do? What is your plan to get there? Some people may use multiple strategies. Once again, I am one of those people. I buy some of everything. But when I buy something, as in a stock, I know the purpose or the strategy behind buying that specific stock. I may separate my portfolio. I may have 3 or 4 portfolios, and each one has its own purpose. I don't recommend doing that up front. I would recommend starting by learning your one strategy at a time. And then once you've mastered what works for you, then identify how you can do multiples. I'm going to pull up 3 sample stocks for you that I bought early on and kind of show you what has happened with them and explain where they fall now. They're still pretty decent buys if you wanted to buy them. But if you would have bought them about 10, 20, 15 years ago, you're going to see the difference. And that's where we get into growth. Now, do you have to wait 10, 20, 15 years for growth stocks to actually make you a profit? No. If you play the game right, 1 year, you're good. Could be sooner than that. All depends on the company itself. And throughout this, we're going to talk about the Buffett mindset as well. Warren Buffett, I studied every book that has been published over the last 20 years about Warren Buffett. I wanted to understand what was his mindset? How did he pick stocks? How does this go? And now at 44, it's the simplest thing I've ever seen in my life. If I would have applied this at the age of 22, oh my goodness, where would I be right now? So we're going to talk about that as well. All right. So what is a growth stock? What's a value stock? Growth stocks are simply stocks that are for sale on the stock market that you buy young, meaning the company is doing pretty well. It's a young company. They might have only been around for 5 years on the market, not how long they've been in business, but how long they've been on the stock market. And over those 5 or so years, they've continued to outgrow the rest of the market. Think of it as a race. Your stock is one runner in the race who's racing with several others. Overall, combined on an average, everyone is excelling at a certain speed, but this one runner is outrunning the rest of them on average. That one is growing or running faster than everyone else. That's what we're looking for when we're looking for growth stock. We're looking for a young stock that is outdueling or doing better on average than the rest of the market. And it's expected to continue doing that over the next few years. We're buying them young because they're generally cheaper at that point. So if I bought a stock and it was $22 per share when I bought it, remember we said a share is a piece of the pie, a piece of ownership of a company. So if I buy it when it's cheap or when it's young, $22, and it's projected to grow over the next 3 to 5 years up to $120 a share. Well, I bought it at $20. If I buy and hold it per share, $20 per share, let's say I buy 100 shares. If I buy and hold it at $20 a share, 100 of them, and it grows up to $120. For every share I own, I have profited $100 when I sell it. Keywords here is when I sell it. So 100 times $100, that is what I have profited from that growth stock. Value stocks is still the same concept. It's just that usually they're at a higher price. So a value stock isn't a young company, generally. A value stock is a company who's been around for a while, that is pretty successful. But at that given time, the stock price may be undervalued based off of what it usually is. So for example, let's use Coca-Cola. KO is their ticker symbol. On average, let's say Coca-Cola costs about $53 a share. Something happens and the herd starts to run. The herd is the mass owners of stocks that are either selling or the mass group of people who are buying based off of something that they've heard or something that's happening, and everyone is running in a certain direction. So let's say for some reason there's something comes out in the news about Coca-Cola and everyone's all of a sudden selling their stocks of Coca-Cola. For a brief period of time, Coca-Cola's share price may drop a little bit. It may go from $53 down to $48. Well, I'm going to jump on it and I'm going to buy more because it's at a value at that time. What's happening with the herd is causing a brief dip in the price of that stock, thus creating a value. That's one way to look at it. It could be that, okay, Coca-Cola is $53 a share. It's where they're supposed to be, but they're continuing to grow. So I'm just going to buy it right now because I'm expecting them to gradually continue to grow. A growth stock example, perfect example, was Facebook. When Facebook came on the scene as an IPO, they were about $17. They started out around 30, I believe, and then dipped down to 17. Once again, jumped on it, bought as much as I possibly could at the given time. At $17 a share, and now today it's about $210, $220. That's a huge gain. That if I bought 1,000 shares of Facebook at $17 and sold them today, my profit would be huge. That's what we're looking at with growth and value stocks. It's the same concept. It's just that with growth stocks, you're looking at younger companies. Value stocks, you're looking at established companies that have been around for a while that may cost a lot more than what you would have paid for a growth stock. Both are good choices. Both fall under that growth stock kind of concept. You just have to know the difference, because there are some times where I might look at a stock that has been around for eons, for 20, 30 years. The company's just been around a long time. But the expectation of growth may cause me to say, hey, okay, this might be a good buy. It could be that I was reading some research that was done, some analysis from a financial analysis from Yahoo Finance or something. And I see the expected growth over the next 3 to 5 years is about 60, 75%. That's pretty good. That means for everything I buy right now, I can expect the expectation it's going to grow 60 to 75%. Now, is it guaranteed that that's going to happen? There are no guarantees when it comes to investing, ever. Never, ever, ever expect a guarantee. What you're working on is based off of facts, knowledge, trends, things of that nature. Thus, with growth and value stocks, both require research and patience. It's not the same where with dividends, I know exactly how much I'm going to get and when I'm going to get it. I'm not looking at the price of the stock with dividends. I'm looking at when is the announcement date, how much you're going to give me for the number of shares, and by what date do I need to have those shares, and when am I going to get a payment. Those are facts that once the announcement happens, they can't change it. It's guaranteed. I can manage that. With growth and value stocks, there's nothing I can manage. There's no guarantees. I am buying into something that I believe based off of facts. I keep stressing based off of facts. I don't base how I purchase growth and value stocks off of a gut feeling. I don't base it off of the fact that I simply like them. I don't base it off of the fact that they may be doing something that hits my heartstrings, because that's not a guarantee that it's going to grow just because it hit my heartstrings. This is where emotions have to just kind of take a sidestep sometimes. Now, I'm going to be honest. There are some times when my emotions can't take a sidestep. I was looking at a company to buy into that was selling some bogus meat that I just couldn't get with. It was developed in somebody's lab. I couldn't. Next thing you know, McDonald's will be selling sale meat, and I couldn't put my money there. That was I couldn't do it. My emotions got the best of me in that situation, and I'm okay with it. And there are going to be some times where you're going to say, I just can't put my money with the company because I don't believe in them. I don't believe in what they represent, and that's fine. And then there are some times where it's borderline for me. It's going, okay, well, you guys are doing this, and I don't like that. But It's not to the point where I can't invest in this particular company because I see the growth. That's a call that you as a human being will have to make. But as an investor, you're going to come to a crossroad at some point where you're going to have to make a decision whether this deal or this stock that I'm buying into, is it about my personal emotions or is it about my ability to create income? And can I separate the two? There are going to be some times when you can, and there are going to be some times when you can't. The sale meat, the bogus fake meat, that was one of them times where I couldn't do it. But that was a me thing. There are some things that I might buy into that others may say, hey, why did you buy that? They're X, Y, and Z, but I wasn't looking at the fact that the COO, one individual that's a part of the company that does some things that I may not agree with, not so much from a business perspective, but who they are as a person. And I might separate them from my decision to purchase into a company as a whole. But that is an individual decision. But the one thing I do want to make sure of is that I believe that any company that you take a look at, you can find something wrong with every single one of them. Just take a look at the people, you'll find something. So finding that balance of where your red line is, you'll have to find that early in your investment career. So I don't know why I felt the need to dig a little deeper into that. It was kind of on my heart to say, I guess. But Demetrius not buying any fake meat. So anyway, so with growth and value stocks, you're going to have to start learning how to do some research. And you're going to have to practice some patience. And with that patience, one thing I can guarantee you is that when you buy a stock, at some point, the price is going to dip on you. And I'm going to show you some examples of how 3 companies that I've bought into as far as stocks, that over the course of years, they've taken highs and lows, but by holding on to them, I was a winner. That's what you're looking for. If you cannot handle seeing when you wake up in the morning and open up your app on your phone and seeing, oh, wow, I'm in the red. And by the afternoon, you've tripled your income because it fluctuates, especially in the beginning. That's going to be a challenge when it comes to growth and value stocks because they fluctuate in price all throughout the day. So that's something to watch out for. But learning how to research, that's something that we'll probably focus on next week. We'll spend a whole session on research. And I'll show you some of the tools that I use when I research growth and value stocks. But when we start talking about the Warren Buffett way, it kind of simplifies the research for you because you're buying what you know. And so that's something we'll definitely take a look at when we start doing our video on research time. All right. So dividend stocks versus growth value stocks. Here's the major difference, and I've already said this, but we're going to repeat it. The major difference is the date the profit is received. With dividend stocks, you get paid your dividend based off of the date, the payout date. You have 3 dates you need to know about. The announcement date, that's the day they announce the dividends they're going to pay out. The ex-dividend date, which is the date they're going to check to see how many shares of their stock you have. You must have it by the day before the ex-dividend date, and the payout date. That's the date that they're going to give you your dividends. That golden, you know exactly what you're getting. You can manage that. With growth and value stocks, you do not make a profit until you sell it. Your value grows. It's kind of like owning, stocks are assets. You own your stocks. But until I sell my stocks, I can't pull the value out of them. So the profit received is on the date that you sell them. Whereas with dividend stocks, I receive a profit every time the dividend date is set for the payout date. That's the major difference as far as how you make money with the two. Is one better than the other? Not really. I prefer dividend stocks simply because I can manage that more. I don't have to spend so much time looking at charts and trying to watch and see what's going on today. Okay, well, somebody said something on Twitter, and now all of a sudden the whole stock market has gone wild. I don't have to worry about that with dividends because stocks bounce back for the most part, depending on what you're buying. There's a different breed of stocks that we're going to get into called penny stocks as well. But for the most part, stocks bounce around and bounce back. So when the market goes crazy, Demetria takes a nap and sleeps easy. On my dividend stocks, I do, because it's going to bounce around. I expect it to. What I want to know is, when is my payout date? When am I going to get those dividends? With my growth stocks, I do pay a little bit more attention to them. Not on a daily basis. Penny stocks that I buy into, once again, like I said, we're going to have a separate video on those because those are a bit tricky. Those I watch all day. So I don't do a lot with penny stocks because it takes up too much of my time. But growth stocks, you're looking to see, okay, at least once a quarter when they make their announcements about their financials, that can tell you a whole lot about your company that you're buying growth stocks with. If they are losing money month after month after month, how are you going to grow? Think of your own bank account. And let's say you have a mortgage and you have kids, you have cars that you're paying car notes on. At the end of the month, if the amount of money coming into your bank account is less than the amount of your bills every month, it's going to be hard to sustain that without help. Same thing with growth stocks. If their financials come in and month after month they're losing money with no plan in sight, I run. I'm looking for companies that, okay, you don't have a lot of long-term debt. And even if you do have a lot of long-term debt, you're bringing in enough income that you can handle and pay that long-term debt. What I mean by long-term debt is debt on real estate, things that are beneficial for the company to grow. I'm looking at what's your earnings per share if you do give dividends out. What does their revenue look like? Is it continuing to grow year after year? Are they sustaining and moving and pushing forward? Those are things I'm looking for. With growth stocks, I highly recommend taking a basic corporate finance course. If you can take a basic finance course, which you can find on Udemy, as a matter of fact, I'll find one for you guys and post a link to it. Udemy, $9.99. Wait till the rotating price goes around because they're always shifting their prices. $9.99. Get a basic corporate finance course and everything you need to understand what makes a company grow. You will have, and you'll be ready to buy into growth stocks. If you want to buy outside of the Buffett Way, I'll throw that caveat out there. But even with the Buffett Way, the Warren Buffett Way, he looked at financials a lot. So it doesn't hurt or harm anything to get a corporate finance course there. All right. So the major difference is when you make a profit. With dividend stocks, you start making a profit the date that you receive dividends, which is the payout date. Whereas with growth stocks, your profit is made when you sell the asset. It's kind of like owning, let's say you have some high-end, let's say watches or something in your home that has value. The value of the things your home, perfect example, a comic book collection. You can own a highly valued comic book collection. Can you take the comic book collection to the mortgage company and pay your mortgage? Absolutely not. But what you can do is sell the comic book collection to receive a profit and then take the money from the profit to pay your mortgage. Same thing with growth stocks. You hold them as assets, but the profit isn't made until you sell them. Dividends, profits made on the date of payout. And I think I've kind of overstated this one, but wanted to make sure that you understood the difference. Because when we start talking about your strategy, of course, long-term strategy, buy and hold. You buy it, you don't think about it much, just hold it, and you wait. You wait for it to grow. I don't know many people, especially those just getting started, who are not going to look at their stock every day. I have a person who actually had to remove the ability to see what they have for a while because they were checking it every 5 minutes, and that'll drive you nuts. But the long-term theory is you're buying things that are considered safe. Like I said, there's always a risk. I can't stress that enough. But buying things that are considered safe and holding them. That's one strategy. You're buying blue chip stocks. Can't get my words out tonight. And you're staying within the safe zone. Blue chip stocks are generally things that you find in the Dow 30. Dow Jones 30 is the top 30 companies that are going to be more of your Fortune 500s. Things that have been around for a very long time that are pretty consistent across the board. And those aren't going to be too cheap. So those are more, you're going to find those when they have a value. So you're generally going to find blue chip stocks as value stocks when you can find them at a lower price if you can. Other options is to follow the index. Remember, we talked about indexes where you have things like S&P or the Dow 30, where they have a listing of different companies that are within their portfolio. And you'll hear in the news where they'll say the Dow is down so many points, or S&P is down so many points, or it's up so many points. You can follow those. I don't personally follow indices or indexes, if you want to call them that, because they may have some things that I like and some things I don't like. So I may have some stocks that may be in an index. There's nothing wrong with that. But to completely buy simply on just that index and nothing else, then that's your strategy. The Buffett Way. I've been mentioning him for a while. And I'm going to read a statement that he made, and that's going to set the tone of how to invest the Buffett Way. He said, and then when I say he, this is Warren Buffett. And if you don't know who Warren Buffett is, look him up. He, multi-billionaire at one point. I believe he was one of the richest men in the United States at one point in time. He said that all you have to do is just buy a cross section of America and then never listen to financial analysts or read the papers or do anything else from that point on. So long-term buy and hold, but he's buying and holding things that are commonly known companies, things that you know, basically. He buys things that he bought things that he knew and held them forever. But Warren Buffett is in his 80s, late 80s, I believe. He's been holding on to CocaCola and Ford since before I was born, and I'm 44. He bought into sections of America based off of commonality. How common is it, or was it back then, to have a Ford? How common was and still is Coca-Cola? Those are the type of companies he bought into. Well-known, sustained companies that produce products that the average American will know what it is. He bought names that he knew. That simple, that easy. Thus, the reason why for the month of January, I mentioned about Ford as an option to add to your portfolio. Everybody knows who Ford is. Everyone knows who Coca-Cola is. If something were to happen to any one of these companies, you will know. It would be on Facebook, Twitter, the news, morning news, noon news, afternoon news, midnight news. You would know. That takes out the harsh work of the research, because it'll give you enough time to make changes or adjustments if you need to. Now, just because something comes up in the news, does that mean you need to sell? Absolutely not. It may just tell me, okay, I need to buy more, because guess what's going to happen? The herd is going to take off. Either the herd is going to take off buying, and I'm going to sit still and not buy anything because the price is about to go up in a manner that is not truly reflective of the value of the company. So it might be worth more. The price may be higher than what the company is really worth because of the herd. So I'll sit still. It could be something happen crazy. The Some companies getting sued that I want to buy, and the herd takes off in selling and the price drops. It lowers temporarily. I might jump in and buy because it creates a value at that point, because I don't believe that company is going to go out of business. Perfect example, Coca-Cola. Let's say Coca-Cola gets sued because something happens and they end up having to pay $50 million out to someone. $50 million is nothing to Coca-Cola. Yeah, it may affect the price of their stocks. It may go from 53 down to $50 a share or $45 a share, but it won't stay there because they're grown enough, they're consistent enough to continue doing business in a manner that they can overcome $50 million paid out in a lawsuit. All companies can't handle that. But how are you going to know those things? I can't just simply say based off, Coca-Cola is everywhere. I ain't worried about that. I need to see their financials. Their financials is what tells me they can handle that. They've grown year after year after year after year, and how much they've profited overall. What was their net profit as a company? Those are the things I'm looking at. That will tell me that even though the herd is all selling their stocks, I need to go buy because this company is consistent. That's the Buffett way. Simple. Buy what you know. Buy what you know, but check their financials. Last is a hybrid, which is more of along the line what I like. Streamline IG, we like hybrids, and I think you'll like them too. The reason being, a hybrid is one of those where you get the best of both worlds. I want dividends and I want growth. So not only am I watching you grow every 3 months or whatever the company strategy is as far as paying out dividends, generally it's every 3 months. I'm going to get a small income from holding on to a stock that I'm waiting to grow. That's a win-win in my book. Can't lose that way. Not at least not in my book. As long as the company doesn't close, you're good. But if they're in a position where they're growing and they're giving dividends, that is pretty much a safe zone as far as I'm concerned. So I like hybrid companies that are given, even if it's a small amount, it's still something. And one of the things that you'll start noticing in some of the bigger companies that are out, such as like your Googles and your Amazons, the price is so high that they're going to have to start doing something to attract people to buy shares of their stocks. And when you start giving dividends, that makes them a little bit more attractive. Even if it's a small amount, it makes it more attractive. So these are your strategies that you can apply for your portfolio. Now, are these all the strategies? No. Keep in mind, as I said, this is BBB, bare bone basics, where we are doing things simple. We're streamlining things, making it simple yet effective strategies that you can use. And then as you grow and get advanced, then you can add more and start looking into some other methods there. So that's portfolio strategies. So the 3 examples we're going to look at, I've bought all 3 of these, been buying all 3 of these since probably since I was 22. Some of these I've made some mistakes with, and I'm going to share with you my mistakes. They weren't bad mistakes. It's just cases where I should have held on instead of selling them. I made profits from them. So, but if I would have held on to today, the things that I have bought with these 3 companies, oh my. So let's take a look at Coca-Cola. Right now, Coca-Cola, whose ticker symbol is about roughly estimated around $57. Microsoft is around $165 and McDonald's is around $211. Pricey. These are not growth stocks. These are more value stocks when you can catch them at a value price. Coca-Cola to me right now is a good value stock, simply because it's continuing to grow every day. The price is gradually going up by 10, 15, 20 cents a day. So, and all 3 of these give dividends. Might be small dividends, but they give dividends. Coca-Cola does pretty good. I think their dividend yield is about 3.6%. So for a stable company that's growing at only $57 a share. That's pretty good buy-in. So let's take a look at for the first time, I'm going to give you guys some charts. Let's take a look. Coca-Cola. The 16, 17, 18, 19, that represents years. Now, mind you, I started buying Coca-Cola probably back in 97, 98 time frame, somewhere along there. And at that time, it was maybe between $25, $30 a share. Actually lower than that, maybe 17, 18 back then. So they haven't grown fast, as you can see. But if you were to draw a line across the top of every high point of their price, the numbers on the right hand side that start with 40 and goes 45, 50, 55, 60, that represents the stock price. Just looking at from 2015 to the end of 2019, which is where this ends right here, it has had its dips. It's gone up, it's gone down, the high and lows, but the highs and lows are not dramatic. At one point, it was worth maybe about $47 a share, and it dipped down to maybe 42. Then it went up to about 45 and dipped down to 43 over the span of months. But now it's at a high, it's all-time high for the past 5 years, I'd say, at about $53 a share. So if I would have held on to all of my shares of Coca-Cola, I still own Coca-Cola, but I buy some, I've sold some, I buy some, I've sold some, and that's what I've done throughout the whole time of holding Coca-Cola. But what if I would have bought and just held for 20 years? Well, not as much of a gain as far as growth, but like I said, they give dividends. So if you want to buy it, this to me is a stock that you buy, you hold long term. You're not buying so much for growth as you are a combination of the two. It's not going to grow fast. It will continue to grow. Coca-Cola is doing a pretty good job of preparing themselves for change. They're always looking for companies to buy out, to expand. Perfect example is the more health conscious people become, the more they're looking for alternatives to sodas. So Coca-Cola is buying up everything they can get their hands on that's health related in the form of a drink. Between water to energy drinks to CBD water that's sitting on the shelf ready to go. The research that they're putting in to prepare them to continue to be a mainstay in global market of sodas or beverages. That's the better word I want to use, because they don't want to be known as a soda company. They are a beverage company. So this was a pretty good one. It doesn't grow fast, but it's consistent. It has its highs and its lows, as you can see in the dips, but they give dividends. So if something that I want to hold as an asset, get the dividends from, have a slow growth. I'm not looking for it to give me $1 billion overnight. Coca-Cola is a pretty decent one. It's one that Warren Buffett has held on to since, oh my goodness, the beginning of time. He's had Coca-Cola for forever, and it has been his number one, one of his number one, well, you can't have but one number one, but one of his major holdings in his portfolio, not just his personal portfolio, but his company as well. Let's take a look at Microsoft. Here's one that hurt my feelings. Microsoft, once again, started buying them in the late 90s, my 20s. At that time, Microsoft was maybe $25 a share. They weren't giving any dividends. I held on to them for a little while till probably they hit about the $40, $50 mark. And then I sold every single share of Microsoft that I owned because I was sick of them. I was sick of them as a company, and I was sick of them as a technical person supporting their product. I was sick of the blue screen of death that used to come up on our screens all the time, so I sold them. It was an emotional decision. Imagine holding on to, let's say, roughly 100 shares of Microsoft that is now worth bought them, let's say at $25 a share, and now it's worth $160, $165 a share, and they give dividends. It's a small dividend, but they do give dividends. Well, yeah, my feelings are a little bit hurt, but Microsoft started it with that blue screen of death. I got tired of them. So just to show you now, you don't see as many dips with Microsoft. You don't see as many hills and valleys. It's been pretty much a straight shot up. Do I think they're going to continue to grow? Absolutely. It's just that it doesn't happen overnight. And that's the thing I'm trying to get people to see when it comes to growth stock. Anything with stocks. Don't think of buying stocks as your meal ticket to becoming rich by tomorrow. Now, is it possible? Absolutely. I'm not going to tell anyone that is not possible. It's just not quite reality. This, what you see, is reality. It takes time and it's a stepping process. It's going to be dips and valleys as you go through it. But like I said, Microsoft kind of hurt my feelings. Do I own any Microsoft right now? No, not in my personal portfolio. They are a part of something like my 403B. So I make sure technology is a part of that because I'm a big fan of technology. So I support my industry that way. But as far as my personal portfolio, I don't own not one share of stock anymore of Microsoft. I sold them. I made a profit on them. But if I would have held, I would have more than tripled the profit that I did make off of them. And this is the thing you have to think about with growth and value stocks. Okay, well, how long do you hold it? When do you sell? For me, I look at my growth stocks as assets. And so I may hold on to stocks, even if it's not for them to grow as fast, like CocaCola, to where I might say, hey, I want to take a trip. I want to go take a vacation to Bermuda. And instead of taking money out of my income that I make from working on my job, I pull it from my assets. My assets create money to do the things I want to do and to buy the things I want to have, not the job I work on. That's a mentality that has taken years for me to understand and to get. That's a difference between, and I hate to use this, but I'm going to. That's a difference between being hood rich and being wealthy. One of the differences. So that mentality shift helped me to kind of do things a little differently. So the income I make from working a job is not, it gets you away from working paycheck to paycheck. It starts that process. Now, am I guaranteeing that? Absolutely not. But it's the things that if you ever read the book, Rich Dad, Poor Dad, it's that mentality that he talks about in the book. The difference between the things that he learned from his rich dad versus the things that he learned from the poor dad. So let's move on to the last one here, McDonald's. Now, I bought McDonald's heavily in the 90s because McDonald's is everywhere. Everywhere. You can't go anywhere on earth and not find a McDonald's. I believe there's a McDonald's on the moon at this point because they're everywhere. At the point I was buying McDonald's, it was $35 a share and pretty decent dividends. Look at how much they're worth now. Right now, they're about $2.10, $2.13, something like that, based off this chart. But once again, you see the growth over time, over years, and you still see the dips and valleys where it's going to go down a little bit, then it's going to skyrocket up. It's going to go down a little bit, but skyrocket up. This is what happens with growth stocks. McDonald's no longer qualifies as a growth stock to me, my personal opinion. You catch them on a value. Once again, I did sell some of my McDonald's, not all. I've held on to some there because I like the dividends that they've given. This gives me a good hybrid. Now, at buying them at the cost that they are now, would I buy them for the purpose of dividends? No, because it doesn't hold the same value as when I bought them at 35. If I wanted to buy McDonald's, I would get them as a part of a portfolio or something like a mutual fund. Unless there's something that they're doing major that I know is going to cause them to increase as a company, or buy in small quantity to where you're using one of the brokers that we've talked about earlier, like Robinhood doesn't sell, and you have to buy the whole share, not partial. But there are apps out there that will let you buy partial shares of a company if you wanted to get McDonald's. However, the only way you get a dividend is if you own a whole share. For every whole share of a stock, that's when you get a dividend. With growth stocks, however much percentage of a share you have, it grows. Perfect example, if you were to buy Amazon, which is, oh my goodness, what, $1,500 a share right now? If you bought $100 piece of it and it grew, you will still gain the value off the growth. So that's one of the other differences between dividends and versus growth. So just wanted to kind of show you, looking at a chart, just glancing at a chart, where's the stock going? If it's all over the place, where in 2016 it was worth $100 and 17 they went down to $15, that's a stay away from me. If the dips are within a reasonable percentage, no more than 10-15%, unless the entire market took a dip. If everybody takes a hit, it wasn't the company that was doing something wrong. It was the market. It's kind of like a test, a standardized exam. If you gave a group of students a test and everybody that took the test got number 10 wrong, then maybe it was the test and not the students. But if you're saying that some students did well with that question, some didn't, then maybe it was those particular students. If 3 students didn't get the question wrong, but everyone else did, then maybe that question is okay. Same way we look at the stock market. If everybody is being affected, then it's not the company itself and how they do business. It's the market. We're going to call the market those invisible people. And sometimes the invisible people make things happen that will make everyone's stock price dip down a little bit. Those are things that I don't let sway me, because it doesn't tell me that the company is being ran bad. It doesn't tell me that the product that they're providing is horrible. It doesn't tell me that the leadership that's running the company don't know what they're doing. That's the cases where my emotions just don't follow the herd with. So, wanted to give you that real quick. So this is just our first session on growth stocks and getting you started. As usual, if you have any questions, send me an email at info@streamlineig.com. Have a good one.